When you start looking at home builder stocks, everyone runs into the exact same wall. Lennar or D.R. Horton, LEN or DHI. Both are the biggest home builders in America. Both seem to move in the same direction on the chart. Both get mentioned in the same breath every time Wall Street talks about housing. So most investors just pick one based on price, or worse, just flip a coin. And that, ladies and gentlemen, is exactly where people leave money on the table. Because once you look under the hood, LEN and DHI are not the same bet at all. They are built differently. They make money differently. They are exposed to rate cuts differently. And right now, in this specific moment in the housing cycle, one of them has a clear structural edge over the other. If you watch this video all the way through, you will know exactly which home builder fits your portfolio, and you will understand why Wall Street analysts are quietly rotating between these two names instead of just holding both. Let's get into it. First, the big picture. Why are home builders even on the table right now? The Federal Reserve has already started cutting rates, and the market is pricing in more cuts heading into next year. Mortgage rates, which were sitting above 7% for most of the last 2 years, are starting to drift down. And here is the thing. There is a massive structural housing shortage in the United States. Estimates from Freddie Mac and various Wall Street desks put the shortage somewhere between 3 and 7 million homes. That is not a cyclical problem. That is a decade-long tailwind. So the setup is simple. Lower rates plus chronic undersupply equals a strong multi-year runway for the builders who can actually deliver homes at scale. And nobody delivers at scale like D.R. Horton and Lennar. Together, these two companies build roughly 1 out of every 5 new single-family homes sold in America. That is a duopoly hiding in plain sight. Now let's break down each name. Start with D.R. Horton, ticker DHI. This is the largest home builder in the United States by volume, and it has held that crown for over 20 years straight. Horton's whole identity is built around one word: affordability. Their Express Homes brand targets first-time buyers, and the average sales price across their portfolio is noticeably lower than Lennar's. Why does that matter? Because in a high mortgage rate environment, the entry-level buyer is the most rate-sensitive buyer. When rates come down even 0.5%, demand at Horton's price points snaps back fastest. Horton closed over 89,000 homes in their most recent fiscal year. Revenue came in around $36 billion. Gross margin sits in the low 20s. And here is the number that matters most to value investors. Horton trades at a forward price-to-earnings ratio in the high single digits, sometimes around 9 or 10 times earnings, depending on the day. For a company this dominant, that is genuinely cheap. Horton's balance sheet is also a fortress. Net debt to capital is under 20%. They have been buying back stock aggressively, reducing share count by mid-single digits annually, and they pay a small but growing dividend. According to analysts at J.P. Morgan and Wells Fargo, Horton has the best return on equity in the entire homebuilder space, consistently above 20%. So, Horton's pitch is this: biggest, cheapest, most efficient, most exposed to the entry-level buyer who benefits first from rate cuts. That is the bull case in one sentence. Now flip over to Lennar, ticker LEN. Lennar is the second largest builder, but they are playing a fundamentally different game. Lennar's average sales price is higher than Horton's. They sell to a slightly more affluent buyer. Their margins on each home tend to be a bit thicker. And critically, Lennar has been undergoing a strategic transformation that most retail investors have not fully digested. Lennar is moving toward what they call a land-light model. Instead of holding huge amounts of land on their balance sheet, they are spinning off land assets and using option contracts to control land without owning it. They already spun out Quarterra, and they are working on a separate land company spin-off called Millrose Properties. What does this mean in practice? It means Lennar is becoming a pure-play manufacturing business. Buy land just in time, build the house, sell the house, repeat. Higher return on capital, less cyclical exposure, more cash returned to shareholders. Lennar closed around 80,000 homes last year. Revenue around $35 billion. They are trading at a forward PE in the high single digits to low tens as well, similar to Horton. But here's the difference. Lennar's free cash flow is exploding because they are unloading land off the balance sheet. Wall Street is forecasting Lennar to return potentially over $5 billion to shareholders through buybacks and dividends over the next 18 months. So Lennar's pitch is strategic transformation, land-light model, higher quality earnings, massive capital return story. Now the real question, which one wins right now? Here is how I would think about it. If you believe rate cuts are coming fast and the entry-level housing market is about to explode, Horton is the cleaner trade. Horton has more operating leverage to a demand surge at the lower price points. When that first-time buyer comes off the sidelines, Horton's order book fills up faster than anyone else's. Analysts at Goldman Sachs have specifically called out Horton as the highest beta name to a housing recovery. But if you believe we are entering a longer, more grinding cycle where capital efficiency matters more than raw volume, Lennar is the smarter long-term hold. The land-light transformation is not priced in yet. Most retail investors still look at Lennar as just another builder. They are missing that the business model itself is being upgraded. When that spin-off finalizes, Lennar should re-rate higher because the remaining business will deserve a higher multiple. There is also a risk angle to consider. Horton is more exposed to the South and Southeast, Texas, Florida, Georgia. Those markets have seen the most aggressive price corrections recently. If Sunbelt housing weakens further, Horton feels it first. Lennar is more geographically diversified, with strong positions in California, the Northeast, and the Mountain West. So Lennar carries slightly less regional concentration risk. On valuation, both are cheap by historical standards. Both trade well below the broader market multiple. Both have buyback programs that are actively shrinking share count. Both have investment-grade balance sheets. Honestly, you cannot make a terrible decision with either one. But if I had to pick one structural winner for the next 2 to 3 years, the analysis points toward Lennar. The land-light transformation is the kind of corporate change that quietly compounds shareholder returns over time. It is the same playbook that took asset-light businesses in other industries from boring to premium multiple. Wall Street is starting to notice. Citi, Barclays, and RBC have all upgraded their stance on Lennar specifically because of the spin-off catalyst. For a shorter-term tactical trade tied to rate cuts and entry-level demand recovery, Horton is the sharper instrument. Higher beta, faster snapback, dominant market share at the price point that benefits most from cheaper mortgages. A reasonable portfolio approach for someone who wants exposure to the entire homebuilder theme. Split the position. 60% Lennar for the structural story, 40% Horton for the cyclical kicker. Or, if you want one name only, match it to your investing horizon. Long-term compounder, go Lennar. Cyclical trade, go Horton. One more thing to keep on your radar. Watch the ITB ETF, which is the iShares U.S. Home Construction ETF. Both LEN and DHI are top holdings. If ITB starts breaking out on volume, that is your confirmation signal that institutional money is rotating into the homebuilder space. Right now, that ETF has been consolidating, which usually precedes a directional move. To wrap this up, Lennar and D.R. Horton look like the same trade on the surface, but they are not. Horton is the volume king, the affordability play, the highest beta name to a rate-cut-driven demand surge. Lennar is the transformation story, the capital efficiency play, the quiet compounder with a catalyst that most people are still ignoring. Both are cheap. Both are well run. The question is not which one is better in the abstract. It is which one matches what you are actually trying to do with your money. If this kind of side-by-side breakdown helped you think more clearly, please hit subscribe and like so I can keep bringing you deeper analysis like this. Take a closer look at the names we covered today. Match them to your own strategy, and I wish you all profitable investing. As always, do your own due diligence before making any decision.